Rossari Biotech is acquiring Tristar Intermediates at an enterprise value of 120 crores, 7.7 times of its EV/EBITDA, which is at a discount to its earlier acquisition of Unitop Chemicals at 10x of EV/EBITDA. With Unitop, Rossari gets higher exposure to surfactants-based chemicals, catering to agrochemicals and oil and gas segments. Tristar Intermediates provides access to preservatives, aroma chemicals, and home and personal care additives with high-tech distillation facilities. This underlines an emerging theme in the chemical sector where companies with pristine balance sheets are looking to consolidate market share or enter complementary chemistries or end markets. Established in 1998, Tristar Intermediates gets about 60% revenue from personal care additives, with Godrej as its marquee client, and exports account for about 53% revenues. Its product range also has applications across diverse industries such as pharmaceuticals, textiles, paints, automotive, agrochemicals, etc. The company operates at Vapi in Gujarat with a total capacity of 15,000 tons. Of this, 5,000-ton capacity was added in the last 1 year. At peak utilization, it can clock about 200 crores worth of top line. Rossari will acquire 76% equity share capital of Tristar Intermediates on closure of the transaction and the remaining 24% over next 3 years. This is similar to the Unitop deal in which 65% equity share capital has been acquired, with remaining 35% to be acquired over the next 2 years. In both transactions, Rossari doesn't intend to raise any debt. Also, recently, the company concluded a preferential issue of equity of 300 crores, which will help complete both the deals. The payback period for the Tristar deal at about 5 years appears reasonable. Rossari's M&A strategy is focused on encompassing complementary technology, talent, products, and client base. Tristar Intermediates helps in getting new product range with high purity levels, which later on Rossari can forward integrate to formulations and or cross-sell its existing client base. In addition, Rossari gets access to a new client base, particularly those based in Europe. In a parallel development, Rossari is also acquiring remaining 40% of its subsidiary, Rossari Personal Care Products, from existing shareholders, making it a 100% subsidiary. The move underlines Rossari's focus on strengthening personal care end market. Here, it will focus on skincare, cosmetics, and body care segments. Coming back to Tristar, while the EBITDA margins are expected to remain close to 14 to 15% in the near term, which is lower than its parent business, the company is focused on a higher asset turnover of 3 to 4x, which may help the company maintain an ROE of more than 30% in time to come. Tristar's operating margin is a key monitorable as it improved from single digit to current levels in the last few years. The management ascribes this to better demand for its specialty grade, high purity personal care additives. We are encouraged by Rossari's inorganic strategy, aiming at clean balance sheet entities with a complementary set of clients, processes, and products which can help it cross-pollinate different functionalities. Performance Chemicals business will remain its core, and to expand the ambit, the company is seeding for new products related to paints, paper, ceramics, and water treatment chemicals and markets. Among other areas to look at are silicon-based chemistries and new product range in polyester resins. Commissioning of the Dahej facility provides a profound capacity headroom for the medium term. The project now adds 1.32 lakh tons to capacity, taking the total to 2.52 lakh tons, an expansion of nearly 2.1x. The company hopes to fully utilize new capacity in the next 3 to 4 years. Animal healthcare is another growth area, while textile remains a cash cow requiring limited investment. Rossari is led by technocrats with strong domain knowledge, which has helped the superior execution of capex projects in the past, diversification into new end markets, and inorganic initiatives. Overall, we find comfort in the fungible operational setup, which helps the company swiftly shift to other product groups in demand. Additionally, its debt-free status helps it navigate through tough times. The stock trades at an expensive valuation multiple of 39x EV/EBITDA for FY23. Relative valuations are at quite a premium compared to large peers in the chemical universe like Aarti Industries, Atul Industries, and Galaxy Surfactants. While we see it as a worthy growth stock with exceptional earnings growth rate, capacity headroom, and product launches for the long term, we believe investors can wait for market gyrations to accumulate this stock at lower levels.